Okay, good evening, guys. Hope you all are doing well. So, like I promised, I'll be, focusing entirely on standard costing and variance analysis today. Okay, so the reason why I chose to take one entire day for this is simply because I find a lot of students they tend to get a little confused with variance analysis. Okay, and unfortunately, variance analysis for some reason the examiner tends to keep on questioning. So like even in, like a, okay, somebody has joined. So even though it's all MCQ based, there is a very good chance that definitely one MTQ will be from variance analysis. And although they are, having one MTQ for variance analysis, there's a very good chance that even in the first few MCQs also they test this area. So it tends to be an area where the examiner, at least about, if you ask me, about 12 to 14 marks easily, it gets allocated for variance analysis. Okay. So first thing I want you to do is, if you have learned variance analysis in the past, please do me a favor and forget it. Okay. Because why I'm saying that is, there are different methods, or it's not different methods really. It's just that different approaches to doing variance analysis. Okay, meaning more or less everything ends up with the same answer, the same technique. It's just that different people use different words. Like unnecessarily, people have complicated variance analysis. Okay, so first thing, if you have learned it, okay, forget it, because let's start from scratch today. I will do only one question, one long question. So you won't have to worry about, differing like the direct material changing or direct labor values changing. Values and all will be the same. Okay. With the information that we have, we will do all the variances possible in this syllabus. Okay. So everything to do with variances plus the reconciliation statement, everything we will cover. Okay. So I'll give the others maybe 4 more minutes in case somebody else wants to join, and then we can start. I had already shared this question, the variance question, with you on the Telegram group. So if you have a copy of it, it will be useful. Okay, if you have, if not, it's fine. Anyway, I will show the question and only do it. If you have it with you, it will be easier. Right. Give me a second while I clean up my slide a bit. I'll start at 6:10. Okay. Just to give people time to join. Okay. Let me share this. Right. So first, let me start off by explaining what is variance analysis. Okay. So why do we have to do this variance analysis? Okay. Now, if you are familiar with management accounting, you know that one major area that we focus on is budgeting. Okay. So what is budgeting? Basically, you plan for the future. All of us do budgeting, right? Whatever it is, in even in our day-to-day lives, we are used to planning. For example, if you have booked your exam next week, then automatically you will start a kind of budgeting where you start planning your time. Yeah, you will say, this day I'm going to learn this chapter, the next day I'm going to do these questions, third day I'm going to revise. So everybody naturally is good at planning. If you're not good at it, it's difficult to survive. Okay. But now if we actually take the time to plan, okay, what actually happens? Now, say we plan for 3 months ahead in a company, we plan for 3 months ahead, we plan for sales to be 10,000 units, for example. If that doesn't actually happen, that means there is a problem with our plan. Yeah, if we have budgeted that we have to sell 10,000 units in 3 months' time, and 3 months later, when we actually look at what happened, we did not actually, sell that 10,000 units, something is wrong with our plan. Okay. So what should we do? There is no point in, just having a plan, and then if it doesn't work out, saying, okay, sorry, it didn't work out, and just forget about it, right? If you made a plan, a budget, and that budget didn't actually realize what actually happened was completely different, then you have to compare the budget with the actual. You have to compare the budget with the actual and see if there is a difference. This difference is only called a variance. Okay. Now, for example, if this variance was adverse, meaning it was not good for us. Let's say we predicted that in 3 months' time we will sell 10,000 units, but we only sold 8,000. So there is a variance of 2,000. Okay. Now, if this variance, if it is adverse, now selling 2,000 less is bad for us, right? So that is adverse. Then first you have to start analyzing why that 2,000 came about. So for example, maybe the quality of our products dropped. Maybe we had a particular salesperson who was really good at selling. Maybe he left. Okay. Maybe people in the country, they found a proper competitor. Okay. So they are now opting to go for the competitor's product as opposed to yours. Okay, so these are problems. So whenever there is a variance analysis, it becomes a clear indicator of a problem that we are having in the business. Okay, so if you want your business to actually do well, then you have to address these problems. If the quality has dropped, then look at your quality control, see if something is wrong and rectify it. Okay, if there is no proper salesperson, the person who is actually doing well, he has left, then find another person who can replace him. If there is competitors who have entered the market, then maybe have an advertising campaign, do something and make sure that the customers are again, attracted to your product. So the variance analysis is very important because that is the only indicator to say that something is going wrong. If you didn't do a variance analysis, then nobody knows what's happening. Somebody is doing a budget, somebody else is doing the actuals, something is happening, maybe there is a profit, and then, we don't really care about what has happened in the business. Okay, if you neglect it like that, in the long run, you will have to, face severe consequences. Okay, so in this chapter, what are we going to do? We are going to learn how to calculate these variances. Okay, it's not as simple as it sounds. Okay, right. So let's start off by looking at this question. It says here, a company produces and sells one product only. Okay, so they are only producing and selling one product. The standard cost for which is direct material 11 liters at $2 a liter, 22. Now, before I read this, you have to understand what is this standard cost. Okay, standard cost means, now if you are going to make one product, let's say this product is a chair. Standard cost means how much it should cost you to make this chair. Okay. So for example, direct material, you should use 11 liters of paint. Each liter of paint is $2. $22 has to be used in direct material for the chair. I'm just saying. Direct labor means per chair you have to spend 5 hours working with it. $6 you're paying per hour. So ultimately your direct labor cost is 30. Variable overheads, anything that you're incurring, that is an overhead. It's not direct material, it's not direct labor, it's not direct expenses. It is something other than that, but it is variable, not fixed. That is 10 per unit. Fixed production overhead, that is 20 per unit. Then it says the total standard production cost. So what that means is, according to my budget, it should cost me $82 to make a chair, the cost. Now to this, I can add whatever profit I want. Okay, so here they're saying that the profit is 38. So I add 38 to 82 and I can find out, okay, if things go according to plan, this chair, I have to sell it for $120. So this is, in other words, all the budgeted data. This is all the budgeted data. Okay. Then it says the variable overhead is incurred in direct proportion to the direct labor hours worked. Okay. The budgeted sales, again budgeted sales for May is 2000 and the budgeted production is also 2000. What is variance analysis? Comparing this budget with what actually happened. So what you will notice in all variance analysis questions is the question will be divided very clearly into two parts. You know, I mean, they won't say budget and say it, but when you read it, you will be able to figure out, okay, this portion of the question, they're talking about budgeted data. Okay. And there will be another portion of the question where they will start talking about actual data. So that's what it says here. The following were the actual results recorded during May. Okay. Number of units produced and sold, 1,750. Already there is a variance. We can see. We were supposed to sell 2,000, produce 2,000, but we have only produced and sold 1,750. Okay. Sales revenue, they're saying it was 218,750. Direct material, we have used 19,540 liters and it has costed us 41,034. Direct labor, we have used 8,722 hours. It has costed us 47,971. Variable overheads is this much, fixed overheads are this much. Okay, then we get the total sales minus the cost, you will get the profit. This is the actual profit that you have earned. Okay. It's saying prepare a flexed budget and calculate the total variances. Okay, so variance analysis, it actually starts off with the flexed budget only. Okay, so I think I explained this in the first ERG. I will go through this once more. Okay. Now, original fixed budget. So this is what we planned right at the beginning. What did we plan? We planned to have sales of 2,000, production of 2,000. Okay. And then we decided that our standard selling price, it has to be 120. So that's the budget. So 2,000 units, you will sell at 120. That will give you 240,000 as sales revenue. Okay, so if you want to get profit, you have to deduct the cost of production. So let's get all the budgeted data. Direct material, the standard cost was 22 per unit from the question. Direct labor, it was 30. Variable overheads, it was 10. Fixed production overhead, it was 20 per unit. So we take those figures multiplied by the number of, number of units that we budgeted to produce, which is 2,000. And you will get these answers, 44, 60, 20, and 40. When you add them up, it's 164. That is the cost of production. 240 minus 164 is 76. Okay. Now you forget about this flex column. I'll talk about it in a bit. Let's look at what actually happened. Okay. So they're saying in the question itself, it was given to us. We produced and sold only 1,750. Okay. And they're giving us the sales, the direct material, direct labor, variable overheads, fixed overheads, everything is given directly together with the actual profit. Okay, so all that I have done is I have copied everything here. Okay. Now, let's say I'm the CEO of the company. I told you, let's forget about this flex budget, right? Let's assume it's not there. So I look at the original fixed budget. I see, profit has to be 76,000. I look at the actual. Profit is 66,169. Problem. Then I will say, okay, why is that happening? Let's look at all the cost, okay? Another cost. Let's look at the sales value first. 240,000, I was supposed to get a sales revenue. But actually, I have only got 218,750. First thing I will do is I will call the sales manager. Come here. Can you see? Budget was 240. You have only done 218. What happened? You are fired. Okay. Then I will look at direct material. 44,000 I am supposed to spend. I have only spent 41,034. In my budget, I said you can spend 44,000. Actually, this production manager has only spent 41,000. I'm very happy with him. I will call him. Come here. You spent less, no? For you, promotion. Okay. Direct labor. I can spend 60,000. That's my budget. I have only spent 47,000. Again, whoever is in charge of labor, promotion. Variable overheads, I was supposed to only spend 20,000. I have spent 26,166. You fire that guy. Fixed overheads, 40. We have spent 37. Happy. Let's promote him. If you do this, within a few months, you will have to close your company. Reason is, you are comparing two things that are not related to each other. Okay? If we sold 2,000 units, then we can expect a sales revenue of 240,000. Okay, if we sold 2,000 at 120, you can sell per unit and get 240,000. But rationally, look at what has happened. We have only sold 1,750. We have only sold 1,750. So you can't expect him to get 240,000, no, because we have sold 250 units less. Okay, so then what we do is we say, okay, this is not a valid comparison. Okay, so let's prepare what we call the flexed budget. So what is this flexed budget? It is basically like the original budget. Using all whatever we used to calculate original budget, we used to calculate the flexed budget. Only difference is we change the production and sales units. So basically, when we were doing the original fixed budget, suppose we did it for 1,750 instead of 2,000. Whatever figures we would have calculated, that is what we calculate in the flexed budget. Okay. So now look, if we had 1,750 units sold at 120, that is the standard selling price, we should have had a sales revenue of 210,000. 210,000. But look what has happened actually. We have got sales revenue 218,750. The guy you fired, he's actually a good guy. He's able to sell for more than $120 per unit. That means he's a good salesperson. If you did not compare with the flexed budget, if you blindly compared with only the fixed budget, then you would take completely wrong decisions. Right? Let's look at the direct materials. This guy we promoted. Okay? According to the flexed budget, if you produce 1,750 units, you should spend 38,500. This guy has spent 41,034. What did we do? We said 44,000, 41 is less promotion. But that again is a wrong decision. Because for 1,750 units of production, he should have only spent 38,500 according to our budget. But he has actually done more spending. That's a bad thing. You should actually pull him up. Okay. Direct labor, look, we should have spent 52,500. We have spent less, 47,971. So that's fine. Even before we took the correct decision, that's fine. Variable overheads, 17,500, but we have spent a lot more, 26,166. Again, we have to see why that happened. Fixed overheads, we are supposed to spend 35,000. We have spent more, 37,000. That is also bad, adverse. Okay. This is budgeting. I already explained this. If I'm not mistaken, I already explained. Now, what you have to understand is each of these variances that I have calculated. So this is 8,750 favorable is because 218,750 is the sales revenue. which is more than the flexed budget. How much more? 218,750 minus 210 is 8,750. Okay. So the variance or the difference between the actual and the flex budget is 8,750. Why am I calling it favorable? Because I was only supposed to earn 210. I have earned more. Earning more is always a good thing. So that's why I put it as favorable. This 2,534 adverse. It's the difference between 38,500 and 41,034. Why is it adverse? Because I have spent more. That's why it's adverse. Okay. The difference between 52,500, 47,971, that is this 4,529. I spent less for direct labor, that's why it's favorable. So likewise, every figure, I can get the difference between the flexed budget and the actual budget and get variances. That part is also not a problem. I'll tell you why it's not a problem, where the complication comes. It's like this. Now this 8,750, this 8,750 favorable variance, think about it, it's a sales variance. It could have happened because of two reasons. Okay, it could have happened because of two reasons. One reason is maybe we were able to sell at a higher price. We budgeted to sell at 120, maybe we were able to sell at 122. That's why we got more revenue. Or in this question, it's not the case, but in another question, another scenario could be we sold more volume than what we budgeted. Say we budgeted 1,750, but we sold more than the 2,000. So that is why we earned more revenue. Now, as a management accountant, you have to figure out if there is a variance, why did that variance happen? Did it happen because we sold at a high price? Or did it happen because we sold at a high volume? Understood. Because only then you will be able to reward people appropriately. Now, for example, if you were able to sell at a high price, then maybe the salesperson was good. Maybe you have to give him a bonus. If you are selling at a high volume, maybe reason for that is the quality of your product increased. So maybe you have to go and commend the production manager or the quality controller or somebody in the production who is responsible for that. Now, if volume increased because of increased quality and you go and, give the sales manager a bonus for something he didn't do, then that will automatically give a negative vibe in the organization. Understood. So that is why if you have a variance, we have to figure out what caused this variance. Think about direct material over here. It's an adverse variance. Okay, that means we have spent more. So reason we could have spent more is maybe the price of the direct material was higher. We were supposed to buy it at 22. We had to buy it at 25 maybe, for example. Okay, so that is why we had to spend more. Or maybe the quality of the material was low. So the quantity that we have used, okay, the quantity that we have used, it is actually higher. Maybe there was a lot of damages in that particular product. So we thought we can finish it off with 8,200 liters, but because of damages and stuff, we had to use a little more, 8,500. So unfortunately, we had to spend more. So that is why you have to be able to split the variance and see why it actually happened. Because only then you can ask people, the right people, the question. Because accountability is important. You should ask people, why did it happen? But you shouldn't blindly, reward somebody or punish somebody. Okay? Right. Look at direct labor. It is a favorable variance. There could have been two reasons, right? One is we paid them a lower rate than what we, budgeted. So we budgeted $30. We may have been able to pay 28. Okay? Or the number of hours that they took, it happened to be low. So maybe they were efficient. Yeah? So like this, all the variances, you have to be able to split it. That's what we do in variance analysis. Okay. So variances as a whole, we split into two: cost variances and sales variances. Okay. Sales variances is only to do with this top portion, which is the sales revenue. Cost is all of them. Okay. So cost variances, we have direct materials, direct labor, variable overheads, fixed overheads. Under direct materials, we have the price variance. So this is the variance that happens because the amount that we paid for the direct material is not according to budget. The other one is the usage variance, meaning the amount of raw material that we used is not in line with the budget. Closing stock, it's not a variance, but when we are doing this variance analysis, sometimes we can value our closing stock. We will see with the question how that works. Direct labor, we have the rate variance, meaning the amount that we pay is higher or lower than the budget. Idle time variance, that is the amount of time we pay our workers for not doing anything. Efficiency variance depends on whether they did the work faster or slower than budget. Okay. Variable overheads, expenditure is the amount that we pay, whether it was higher or lower than the budget. Efficiency, again, whether our labor hours were faster or slower, because usually variable overheads, they kind of they go in line with the labor hours. Fixed overhead, expenditure, did we pay more? Did we pay less according to the budget? Volume, it's to do with, again, the numbers that you sell. We will come into this in a bit. And this volume variance, you can split it into capacity variance and efficiency variance, all of which we will cover in the question. Finally, we have the sales variances. We have the price variance. So that is if we sold for a higher price or a lower price. Volume margin variance, did we sell more units than we budgeted or did we sell less units than we budgeted? That's the volume variance. Okay. So I'll give you 2 to 3 minutes. Please take this down because first you have to understand what are the variances we need to calculate. Without knowing that, you'll just be like, lost. Okay, so take this down first, and then based on that same question, we will start calculating all these different variances. Okay. So, Mr. First Class, can I give you a brief of what it was? You mean the very first TRG that we did? So, what's your name? I think Taslim. What we did or what we are doing in the TRG, basically, the first 2 classes, we had a mixture of MCQs. Okay, so we actually have a bank of questions that I have shared on the Telegram group. It's basically different chapters, MCQs from different chapters. So what I do is, every time I do a question, I will give you a small summary of that particular chapter and then I will do the question. So that way you can also do it on your own. And at the same time, you get a good, like almost a 90% coverage of the syllabus. But based on popular demand, a lot of students had problems with this particular chapter called variances. Okay, so only for variances, which is today, I have allocated the TRG just for this chapter. Okay, so I haven't done this kind of a revision for any other chapter. Why I am giving importance for variances is because the number of marks that they allocate and the fact that a lot of students tend to have problems with it. So from the next TRG onwards, we will continue with that, bank of questions that we were doing, the MCQs, we will continue. That's how this TRG will work. So up until this point, we have covered a lot of areas like material, accounting for materials, accounting for labor, overheads. We have also covered the forecasting areas. We did budgeting. Variances we have not covered. I deliberately didn't do questions to do with variances. Yeah, so those are basically the areas that we have covered so far. But even in the coming two TRGs, two, right? Yeah, the coming two TRGs, we will cover all the areas again because we are doing a mixture of questions. Okay. So it's not like you would have missed anything as such. How many classes we have done? We have done two so far. So this is the third one. This is the third one. It happens every Thursday. We have another two more. Okay. Right. So let me start. Okay. I'll bring the question down. We'll start with the direct material variances. Right. So what I follow, not only me, there are a lot of people who follow this. It's called the boat method. Okay. Reason is it looks like a boat. In your study text, or I'm talking about the Kaplan study text, even the BPP study text, you will not see them following this pattern. Okay, because in the study text, they expect you to actually think about the question and then decide what the variance will be. But you and I know in the exam, we don't have time to think like that. Okay, we are already panicking. If they ask us to rationally think, we are going to panic some more just thinking about that itself. Okay. So to avoid that problem, I have a set of equations that you will have to learn. Okay, so equation means I'm talking about what I have written inside these boxes. Okay, so don't think that, okay, everything has to be learned from scratch. No, there is a pattern. Okay, most of them have the same pattern. So as you do more and more questions, you will start getting accustomed to this pattern. But for the beginning, maybe the first 20 questions that you're doing, you will have to refer to these equations so that you don't, miss anything. Okay. So how this boat method works is there will be three boxes. Okay. So like the ones in orange, there are three boxes, not orange, beige. Okay. So for the direct material variance, we have the first box called the actual box. Second one called the actual at standard. The third one, we call it the standard box. Okay. In the first box, we put the actual quantity into the actual price. Okay, I'll talk about this in a bit. Here, we put the actual quantity into standard price. It makes sense, no? It's actual at standard. So, one has to be actual, one has to be standard. Okay. And here, we put the standard quantity for actual production into the standard price. So, let me talk about each of them. Actual quantity means the actual amount of direct materials that we used. And the actual price is actually how much we paid for it. This is the same figure here. Standard price is according to our budget, how much should we have paid for 1 unit of this direct material? That's the same figure that you have to put here as well. Okay, under the standard price also you have to put that figure. What is the standard quantity for actual production? That is according to my budget. According to my budget. Now my budget, for example, if you look here, it was prepared thinking of 2000 units in mind. No. Okay. So it doesn't make sense to put any figure relating to that into, the equations because we never produce 2000 units. So what we try to do is we take the standard. I'm supposed to spend $22 no, per unit. I multiply that with the actual production, which is 1750. So standard quantity, which is the 22, for actual production, which is 1750. Okay, so let's start this off and we'll see how it goes. Okay. Right. So we need actual data. So let's go to the actual part of the question. I told you your question will very clearly be divided into the budgets and the actuals. Okay. So here we have the actuals. Actual quantity. Look at the direct material. 19,540 liters were purchased and used. So the actual quantity that we used was 19,540. So that's exactly what has to come here, 19,540. Per liter, how much did we spend? We don't have that data. They're not telling us how much one liter was. They're just telling us for the 19,540, in total we spent $41,034. Yeah, that's fine for us because 41,034 will come here. So 19,540, when I multiply it by the price per liter, the answer should be 41,034. So if I want, I can divide 41,034 by 19,540 and figure out what is the actual price I paid per liter. So let me get that as well. Correct, 2.1. Okay, so the actual price, I'll change the color, 2.1. It may or may not be important. I'll just box it because it was a figure that I calculated. Go to the actual at standard. Actual quantity is the same, 19,540. Standard price, according to my budgeted information, what was the price I was supposed to spend for 1 liter? So let me go to the question. Direct materials, I'm supposed to spend 11 liters and I'm supposed to spend $2 for 1 liter. So the standard price is 2. So let me put that. 19,540 into 2 will be 39,080. Okay. Last one. Standard price is already known. So let's just put the 2 here. We should multiply this by the standard quantity for actual production. So first let's go to the standard and see what's the standard quantity. Per unit, I'm supposed to spend 11 liters. So that is the standard quantity. Okay, so let me go and put that. 11. For actual production, so what was the actual number of units that I produced? 1,750. So that 11, I have to multiply it by the actual production, which is 1,750 units. So 11 into 1,750 into 2, that should give you 38,500. Simple. Okay. Now, what you have to do now is understand that the difference between the actual box and the actual at standard box, that's the first and the second box, that gives you the price variance. Okay. And the difference between the actual at standard and the standard box, that will give you the usage variance. When it came to direct materials, there were 2 variances, price and usage. Okay. So the difference between the first and the second box will give you price. The difference between the second and the third will give you usage. What's important is for you to understand and remember this structure. If you can remember the structure, you can conquer any question to do with variance analysis. Right, so let us calculate the price variance. Before we think about any adverse favorable story, let's just get the difference, okay? So 41,034 minus 39,080, the difference is 1954. And here, 39,080 minus 38,500, 580. Okay, you can ignore plus, minus signs, all of that. Just the difference I'm taking between the 2 numbers, that's all. Okay. Now, let me decide, is this an adverse variance or is it a favorable variance? Okay. Now, for this 19,540, these 2 boxes now. This is the actual at standard box. So, although it has a little bit of actual, it has at least a little bit of standard as well. So, this can be considered as the budget. This box, whatever is in this box, it can be considered as the budget. This is entirely actual data. So, this can be considered as the actual. Now, think about it. According to my budget, I was supposed to spend 39,080. I was supposed to spend 39,080 for direct materials. Actually, I have spent 41,034. I have spent more. If I spend more, it's always a bad thing. That is adverse. So this 1954, it's an adverse variance. Okay. Now let's check the usage variance. Now in the usage variances case, this second box, it has at least a little bit of actual in it. So we can consider this the actual. Because the third one is entirely standard. So this is the budget. Okay, so see, I was supposed to spend 38,500. That's my budget. I have again spent more. 39,000 is more. Spending more, always a bad thing. This is also adverse. Okay. So when it comes to the direct materials, both things have gone wrong. We have paid a higher price also. See, this we have paid 2.1, whereas the standard was 2. And we have used more quantity than the budget as well. Think about it. What is 11 into 1,750? I'll get that figure. 19,250. Okay, I'm just writing it here. 19,250. 11 into 1,750. So I'm saying according to my budget, I should spend 19,250 liters for this production of 1,750 units. But see, I have actually spent more liters, 19,540. Bad thing. That's why this usage is also adverse. Yes, I will explain the adverse part again. Okay. So again, since somebody asked, how are we going to do, how are we going to figure out whether it's an adverse or favorable variance, right? So first thing, when it comes to the price variance, okay, we have to understand that we are comparing the first two boxes. Okay, so in these two boxes, the first box is entirely actual figures. This has a little bit of budgeted or standard figures. So 39,080, that is the budgeted information. 41,034, that is the actual. So according to my budget, I'm supposed to spend 39,080, but I have spent more. Spending more is a bad thing, so this is adverse. Okay. If you look at the usage, the second box versus the third box. So here there is a little bit of actual at least. The third box is entirely standard, entirely budgeted. So according to the budget, I'm supposed to spend 38,500. I have spent more, 39,080. That's also a bad thing. That's why this usage variance is also adverse. Okay. That's how you get the direct material price and usage variance. Okay, so take this down and then we'll move on. Okay, I hope you've taken this down. So let me go back to that first slide that I showed you. Can you see direct material? We had price, we had usage. Both we have learned how to find it. There is a situation with closing stock. So let's see how to deal with that. So when does this happen? Look at this. Redo the above, assuming actual quantity purchased is 19,540 liters and the actual quantity used is 19,000 liters. So in the previous example, what happened is we purchased and we used 19,540. So there was no closing stock of raw material because whatever we purchased, we used it. But here they are saying we have purchased 19,540, but we have used only 19,000. So in this situation, the way we calculate the variances, it will change slightly. Okay. Right. So how this, what happens, what's the difference? It's a very small thing. This actual at standard box, it basically splits into two. Okay. So let me split it. Now, usually it's actual quantity into standard price. Now, here what happens is on one side, it will be actual quantity purchased into standard price. On the other side, it will be actual quantity used into standard price. So that's the only difference. Otherwise, more or less, it's the same. So let's do it. Actual quantities was multiplied by the actual price, 19,540 as before, into the actual price we don't know, but we know that it was 41,034. Okay, so let's put that in. We don't know the actual price, but we know that the answer was 41,034. So based on this, we can get the actual price, which is 2.1. Actual quantity purchased, that we know it is 19,540. Let's put the figures that is, straight away available. Actual quantity used, we know it is 19,000. Now these two we have to multiply with the standard price. So if you go to the budget section, standard price is $2 per liter. So that will be multiplied by 2, multiplied by 2. Here also we have to multiply by 2. Then standard quantity for actual production. So like before, according to our budget, we were supposed to spend 11 liters per unit. We actually produced 1,750 units. So 11 into 1,750. Okay. Right. 19,540 into 2, that will be 39,080. 19,000 into 2, that will be 38,000. 11 into 1,750 into 2 will be 38,500. So like before, the first one will be the price variance. The last one will be the usage variance. What we get in the middle, that is the closing stock. Now remember, closing stock is not a variance. It's just a valuation. The variances are price and usage only. Okay. So let's first get the differences before we decide whether it is adverse or favorable. 41,034 minus 39,080, that will be like before, 1,954. 39,080 minus 38,000, that will be 1,080. And 38,000 minus 38,500, don't think about the minus figures and all. We just want the difference, which is 500. Okay. Now listen carefully. Let's see how to get the adverse and the favorable. Right. So for the price variance, the first box is the actuals. The second one is the budget. So we budgeted to spend 39,080, but we have spent more. We have spent 41,000 odd. Spending more is always a bad thing. This is adverse. Closing stock, I told you it's not a variance, so it won't have an adverse or favorable. It just has the value 1,080. Okay. Then let's look at the usage variance. The right or the third box, that is the budget. The second box, that is the actuals. Okay. So according to my budget, I could spend 38,500. I could spend 38,500. Actually, I have spent less. I have spent 38,000. Meaning the budget allowed me to spend 38,500. But actually, I have only spent 38,000. Spending less is always a good thing. So this 500 is a favorable variance. Okay. So that's how you get the price and the usage variance. One more thing I forgot over here is you can have, I'll give you time to copy the second one, a total variance as well. So that is basically the addition of these two. So 1954 plus 580, which is 2534. Both are adverse. So this is also an adverse variance. So the total direct materials variance will be 2534 adverse. But this total, they won't ask you to calculate, right? If at all they ask you to calculate, they will ask either price or usage. Just showing you because of completion. Okay. And here also you can get the total. Okay, so that will be again 1954 adverse, but here it's 1954 adverse and 500 favorable. Okay, so the adverse variance is only bigger. So the total variance will be adverse, but actually it's going to be 1954 minus 500 because one is adverse, one is favorable now. So that will be 1954 minus 500, which is 1454. Can take this down as well. By the way, this closing stock scenario is very rare. Okay, this splitting the second box is a very rare situation. So mostly in your exam, what they ask is this situation. Okay. Okay, so I hope that's done. Let's start with the labor variance also. Okay, so again, like the direct material variance, direct labor also, you have these three boxes: actual, actual at standard, and standard. Okay, so what goes inside the boxes, it changes slightly because it's labor, right? So we can have a quantity figure now. So what it is here is actual hours into actual rate, actual hours into standard rate, standard hours for actual production into standard rate. Okay, so let's do them one by one and see how to calculate the direct labor variance. Right, actuals, no, the first box is, so let's go to the actual information that we have. We need the actual hours and the actual rate. So look here, direct labor, 8,722 hours. That is the actual number of hours we have worked. And we have paid. We don't know how much is the actual rate per hour, but we know in total we have paid 47,971. So we have the total, like in direct material. So no problem at all. We can just put the 8,722 and the total. So 8,720. 8,722 multiplied by the actual rate, we don't know, but we have the total, which is 47,971. Okay, so what this means is for this entire 8,722 hours of labor, we have paid 47,971. So if you divide 47,971 by 8,722, you can get the actual rate, which is 5.5. Per hour, we have paid our laborers 5.5. Now, let's put the actual hours. Again, 8,722. Into the standard rate, how much was, according to my budget, how much should I pay per hour? So it's saying direct labor 5 hours at 6 per hour. Okay, so the standard is 6. And here also they are asking standard rate 6. Then standard hours for actual production. So for 1 unit, according to my budget, how many hours should I spend? That's the question. It's saying direct labor, we are supposed to spend 5 hours. For 1 unit, you should spend 5 hours making it. So we produce 1,750. So standard hours for actual production will be 5 into 1,750. Standard hours is 5. Actual production is 1,750. Okay. So now we can take totals. 8,722 into 6 will be 52,332. Standards here it's 5 into 1,750 into 6. It will be 52,500. Okay. Now, the difference between the first two boxes, that is called the rate variance, and the difference between the second and the third is called the efficiency variance. One is the rate, one is the efficiency. There were two variances. Okay. I'll explain why one is called rate and one is efficiency. Okay. Anyways, before that, let's get the differences. 52,332 minus 47,971. That will be 4,361. Let's decide adverse favorable later. Then here the difference is 52,332 minus 52,500, which is 168. Okay. Now, let's decide whether this is adverse or favorable. This box, when it comes to the rate variance, this has a little bit of budget. So this is the budget. The second box is the budget. The first one is the actuals. I was supposed to spend 52,332. I have spent less. Spending less is always a good thing. So this is a favorable variance. For the efficiency variance, the second box has a little bit of actuals, whereas the third one is entirely budgeted. Okay. So I have budgeted to spend 52,500. I have spent 52,332. I have spent less. Spending less again is a good thing. So that is also favorable. Okay. So both are favorables. So the total also will be a favorable variance. 4,361 plus 168 is 4,529. Okay. Now I'll explain why it's called rate. Okay. Because now see, the reason why this was favorable is because the amount that we paid is less. Carefully analyze. Our standard is saying pay our laborers 6 per hour. But we have paid 5.5, meaning we have paid them a lesser rate. For some reason, we have paid them less and they have agreed. That is why this rate became a favorable variance. So this favorable variance happened because of us paying our laborers a lower rate, and that's why it's called the rate variance. And why is this called efficiency? Think about it. Actually, we allowed them to spend 8,722 hours doing what we asked them to do. Okay. But if you look at the budget, okay, now actually they spend 8,722. Budget, look at it, 5 into 1,750. I'll just write it here, 8,750. Meaning, I have told my people, my laborers, finish this work in 8,750 hours. They have been good. They have done it in 8,722, meaning they have been fast. They have been more efficient. That is why it has given rise to a favorable variance. Okay. Right. So that is the direct labor variances. Again, this is the most straightforward situation. Most of the time, at least 85% of the time, this is what they will ask. Okay. Can take it down. Right. So since it's 7:05, I'll keep this slide on, and you can take a break, come back at 7:20, and we will continue with the variances. But take this down and then go. Okay, so be back at 7:20. Okay, I hope all of you are back. Okay. Right. So what we have done in this part of this direct labor variance is when you don't have any idle time. Okay. So what is idle time? Basically the time where your workers are available to work. You are also paying them, that rate for that particular hour that they're waiting. But for some reason, the production is not happening. Okay. Maybe there is a shortage of materials. Maybe there is a machine breakdown. Maybe there was a power cut. Okay. So for some reason, the workers are there, you are paying them, but the production is not happening. That is only idle time. Now, if there is idle time, then calculating the direct labor variances, they change slightly. Okay. How does it change? Like how when there is closing stock, this actual at standard is split into two. Here also it will split into two. Okay. So it will be actual hours into actual rate like before. Actual hours paid into standard rate. Then we have actual hours worked into standard rate, and as before, standard hours for actual production into standard rate. Okay. So it's saying redo the above assuming actual hours paid is 8,722 and actual hours worked is 8,700. Okay. In the previous question, the amount of hours that we paid and the amount that they worked both was 8,722. Okay. Okay. So let's start actual hours into actual rate. That is the same, right? 8,722, 47971. So let's take all of that down quickly. $8,722 actual rate. We actually calculated it from the answer, right? The answer was 47,971. So this we divided by 8,722. We got the actual rate as 5.5. Okay. Then we have the actual hours paid. So the amount of hours that we paid was, that we actually paid them was 8,722. Standard rate we don't have yet. Actual hours worked is 8,700. Let's go to the budget. See what the standard rate was. It was 6. So you can put standard rate as 6 and here also 6. Here also 6. Standard hours for actual production. So the actual amount of units that we produced was 1,750. Standard hours, go to the standard of the question, 5 hours. Okay, so this is just a repetition. 5 hours. Okay. So 8,722 into 6 is 52,332. 8,700 into 6 will be 52,200. 5 into 1,750 into 6 will be 52,500. Okay. So the first one, like before, this is the rate. The last one is the efficiency. What you get in the middle is the idle time. Now remember, idle time is a variance. Closing stock wasn't a variance. Idle time, it is a variance. Okay. Let's get the differences. 47,971 minus 52,332 is 4,361. 52,332 minus 52,200 is 132. I'm just taking the difference. 52,200 minus 52,500 is 300. Again, just the difference. Now let's figure out whether it is adverse or favorable. Okay. Idle time, you can close your eyes and put it as an adverse variance. Why is that the case? Because idle time is always a bad thing for us. If we are paying our workers and they are not doing work, that's always a bad thing. So that will be an adverse variance. Okay. So the rate, look at it. This box, the second box, it has a little bit of budget. The first box is entirely actual. So the budget is only 52,332. Okay. So we told them to spend 52,332 on labor. They have spent 47,000. They have spent less. So if they spend less, that's a good thing for us. This is a favorable variance. Okay. And here, the second box has a little bit of actual at least. So this becomes actual. The third box becomes budgeted. So we have told them to spend 52,500 on labor. They have again spent less, 52,200. Again, it's a good thing for us, so it's favorable. Okay. So then for you to get the total variance, okay, it will be two favorables now. So add them together for 4,361 plus 300. So that will be 4,661 favorable. From that, you minus the 132 adverse. So overall, it is a favorable variance of 4,529. Okay. So I'll just show how it was done. It was 4,361 plus 300 minus 132 because these two were favorable and this one was adverse. Okay. This is how you would do it if there was idle time involved. You can take it down. Yeah, so Taslim, you have three areas, right? A, B, and C, right? A is, no, I'm sorry, you only have two areas. It's M and O, so you have A and B. So B will be three questions, okay? All three will be worth 10 marks. It's called an MTQ. So what happens is they will give you a small scenario, maybe about a paragraph or two maximum, and they will ask 5 questions based on that scenario, okay? And the examiner has also mentioned that those 3 questions, basically those 3 MTQs, they will come from variance analysis, performance measurement, and from budgeting. Okay, so that includes capital budgeting as well. So NPV and all also they can ask. But basically it's that. So if you have a revision kit, there will be a lot of questions where you can practice. It's nothing different, right? Because the 5 questions that, they're asking based on the paragraph, that's going to be similar to an MCQ. The only thing is in an MCQ, you don't have a paragraph. Here you have a paragraph worth of information. That's all. Otherwise, there's nothing much. And also sometimes now MCQ means you will have 4 answers and you have to be able to choose the correct answer. Here sometimes they might ask you to type in the answer. Numerical figure, they can ask you to type it in. They can't ask you to type any words in. If at all, they can ask you to type in a numerical figure. MA is nothing to worry about, Taslim. One of the most simplest papers. The only thing is you have to do a lot of questions. You can't expect to pass like FA. Okay, because FA, even if you like half study, 3/4 study, you can somehow pass it. MA, you have to cover 100% of the syllabus plus do questions. Question is important. Okay, because the way in which, they put forward the question and how you're supposed to get the answer, you will be able to figure that out the more questions you do. Okay, if you don't do questions, then yes, you will be a little confused. But I'm telling you, it won't even take a week or maybe 1.5 weeks max for you to finish off that revision kit. If you can finish the revision kit once and you're comfortable, you can remember what you did, just go ahead and sit for the paper. Okay, it's nothing to be worried about at all. Like you have to find a special way to actually do something wrong in an MA paper. Okay? Right. Okay, so I hope this is also taken down. Let's do variable overheads. Okay? Variable overheads, similar, 3 boxes, actual at standard, standard. Here, what goes inside is actual hours into actual VOAR, variable overhead absorption rate. I'll come to that. Actual hours into standard VOAR, standard hours for actual production into standard VOAR. Now, in the question, they're telling you variable overhead is incurred in direct proportion to direct labor hours, right? So what that means is these actual hours that they're asking, you can put in the direct labor hours itself. Okay. So we have actual hours now. So you need to put the actual direct labor hours. So from the question, direct labor was 8,722. I'll put 8,722 here as well. Actual VOAR. Okay. Let's go to the actuals. Okay. We know that the total has to be 26,166. That's the total. Okay. So we don't know per hour what is the variable overhead actual, but we know that the total has to be 26,166. So if you want, you can get the actual VOAR. Take 26,166 divided by 8,722. You will get 3. Okay. Standard VOAR. So let's go to the standards. Okay. They're saying the variable overhead is 10 per unit. Okay. 10 per unit. So they are asking you for the variable overhead absorption rate. Okay. So if it is 10 per unit, you have to divide it by the number of hours, which is 5, for you to get the rate, which is the, the rate per hour. Okay. So that is what we have done here. Variable overhead absorption rate, that is $10 divided by 5, which will be 2 per hour. Always remember, if it's a VOAR, basically an OAR, overhead absorption rate, it is divided by an hourly figure. Usually the base is labor hours, machine hours, it can be anything. Most of the time it will be divided by an hourly figure. So this 2, it has to be 2 per hour. Some of you might think, why am I not using 10? That's also per unit, right? 10 per unit. But see, this is 8,722 hours. So it has to be multiplied by something that is a per hour figure. You can't multiply it by something that's a per unit figure. No, it doesn't make sense. Okay. So that is why you have to calculate the 2. Look at the actual hours. Okay. So Taslim wants me to repeat. Look at the actual hours. It's 8,722. Now, if you have an actual hours figure, you have to multiply it also with a figure that is denominated by hours. So you can't multiply it by 10 because 10 is 10 per unit. So if you are going to put 10 here, then this has to be something to do with units. Yeah. So this is something to do with hours. So that's why we take $10 and divide it by the labor hours per unit, which is 5 hours. So when you divide a dollar figure with an hourly figure, the answer you get, which is 2, is a per hour figure. Okay, so you have to understand this. I think I mentioned this in the first class, to do with absorption costing. When we are doing OAR, we take the overheads and we divide it by labor hours, machine hours, something to do with the hours. So always an OAR will be denominated by hours. It won't be denominated by units. Very rarely only it will be divided by units. Okay, so here it will be 2. This also multiplied by 2. Standard hours for actual production, you must be remembering now that actual production was 1,750. Standard labor hours, if I'm not wrong, it has to be 5. Okay. So 8,722 into 2, that will be 17,444. 5 into 1,750 into 2 will be 17,500. This is called the expenditure variance. And this is called the efficiency variance. Say the differences first. 26,166 minus 17,444 is 8,722. 17,444 minus 17,500, the difference is 56. Let's decide if it is adverse or favorable. Okay. So when it comes to the expenditure, the second box has a little bit of budget. So that is the budgeted. This is the actual. According to my budget, I was supposed to spend 17,444. I have spent more, 26,166. Spending more is always a bad thing. So this is favorable. Sorry, this is adverse. So sorry. Okay. I was supposed to spend 17,000. I spent 26,000. I have overspent. So that's bad for me. It's an adverse variance. Then let's look at efficiency. This box is entirely budgeted. This has a little bit of actual. According to my budget, I was supposed to spend 17,500. I have spent less, 17,444. I spent less. No, that's good for me. It's favorable. Total, the adverse is bigger. So obviously the total variance will be an adverse variance. 8,722 minus 56, you will get 8,666 adverse. Okay. So this is how you will get the variable overhead variance. What you have to remember here is always this VOAR, whether it be standard or whether it be actual. Now actual, we didn't calculate it. It is always going to be a dollar figure divided by an hourly figure. It has to be a per hour rate. Remember that. Okay. If it is a per unit figure, somehow you have to know that you have to divide it by an hours. Only then you can get the VOAR. Okay. Then take this down. Right, so I hope that's done. Right, so variable overheads, you can see that the calculation is based on labor hours. It's based on labor hours. So, automatically, this should change if there is idle time. Like how the labor variances changed when there was idle time. The variable overhead variances also, there will be changes if there is idle time. Okay, so let's see how it will change. Okay, so this is how you will do the variable overhead variance when there is idle time. So it says here, when actual hours paid is 8,722 labor hours and the actual hours worked is 8,700, how will you go about the calculation? Okay, it's a small thing I have to add here. This is actual hours paid. Okay. So for variable overheads, this actual at standard box, it doesn't split or anything. It's just the same. Only thing is we will call the first one in the actual box. Earlier it used to just be actual hours. Now here it will be called actual hours paid. And the actual at standard box, it will be called actual hours worked. That's the only difference. Let's put the figures in. Actual hours paid is 8,722. Actual VOAR, we don't know. I mean, we calculated previously as 3, but we only knew that the total was 26,166. So let's put that in. 26,166. You can calculate it if you want. It will be 3. Actual hours worked, it was 8,700. And standard VOAR, if you remember, it was 10 divided by 5 hours, which is 2 per hour. That's 2. Standard hours for actual production, again, labor hours was 5 into 1,750 was the production. Standard VOAR is 2. This is 8. 8,700 into 2 will be 17,400. 5 into 1,750 into 2 will be 17,500. So this will be the expenditure. And this will be the efficiency. So there won't be another third variance called idle time in the variable overheads. Only thing is the expenditure and efficiency variance, it will change a bit. Okay. Let's get the differences. 26,166 minus 17,400 is 8,766. Here it's 17,400 minus 17,500, which is 100. Okay. Here there is a little bit of budget. First box is entirely actual. So we have budgeted to spend 17,400. We have spent more, 26,000. Spending more is always bad. This is adverse. You might be thinking, right, why I'm repeating the same thing again and again. Thing is, I want you to get used to saying that. Okay, because if not, you'll end up anyway making a mistake with this adverse favorable. So my idea is by the time this session is over, it should stick in your head that when you're getting the adverse and favorable, the way you think is by deciding what is the budget, what is the actual, is it good or bad, and then go for adverse or favorable. Okay, I know it might seem babyish, but it'll help. In your exam, you will hear me. Okay, right. Standard is budget. Here there is a little bit of actual. The budget was 17,500. I have spent less. If I spend less, that's always a good thing. So this 100 is a favorable variance. So the total will be adverse and favorable. So it has to be deducted. Total will obviously be adverse because adverse is more. So 8,766 minus 100, the total will be 8,666. Right. Quickly take it down. There's nothing much here. It's just that the actual hours paid and worked, it will be separated. Right. So this is the same question, right? I've just copied it again because I can't be scrolling up again and again, right? So we're done with the variable overheads as well. So let's quickly go back to that chart that we had. Okay. We did price, we did closing stock, we did usage, we did rate, idle time, efficiency, expenditure efficiency, with and without idle time. So now we only have few more left. Okay, so it's a good thing, right? Can you see it's not very complicated? If you know the equations properly, no problem. Okay. Right. So let's look at the fixed overhead variances. Fixed overheads, they are like the black sheep. They are little different to the other variances. Okay. Why is that? Think about it, because it will change depending on whether we are using absorption costing or marginal costing. If it's absorption costing, we are absorbing the overhead into the cost unit. If it is marginal costing, we are not. So that is why fixed overhead variances, you might feel that it's a little messy. The rest, of course, it shouldn't be a problem. This I understand it will be a little messy, but I will clear it for you. Okay. Right. So how do we get this fixed overhead variance? Again, we have three boxes, but all this while it was actual, at standard and budgeted. No. Now it will be actual, budgeted and absorbed. You will have to accept it. Fixed overheads, three boxes, but it will be actual, budgeted, absorbed. And good news, actual, there is no formula. Directly it has to be given in the question. This was the fixed overhead actually incurred. So no formula. You can just put the answer here. Under budgeted, you will have budgeted units into standard FOAR per unit. I'll tell you how to calculate it. It's given here. Under absorbed, it will be actual units into standard FOAR per unit. So how do we get the standard FOAR per unit? It's the budgeted fixed overheads, total budgeted fixed overheads divided by the budgeted production. Okay. So based on our question, let's try to get the fixed overhead variances. Actual information, fixed production overhead. I told you it has to be given directly. 37,410. So be happy. Write it 37,410. Okay. Then you have to take the budgeted units. So if you go to the budget, the budgeted production, okay, when you're doing all the cost variances, guys, remember this, when you're doing cost variances, so that direct material, direct labor, variable overheads, fixed overheads, when we're talking about units, we're talking about production, not sales. Okay, only when we are doing the sales variances, those two, we'll take the sales units. Otherwise, it's always production. In this case, both are the same. Okay. So the budgeted production is 2,000. Easy. We can write that also. Actual units that we produced, that also we know, 1,750. Okay. So that's also not a problem at all. Budgeted units, actual units. Now we need to get the standard FOAR per unit. So to get this, you have to look at the standards. Let's look at the fixed production overhead. They're telling you it is 20 per unit. Okay. There was a equation, right? I told you standard FOAR per unit equals to the total production overhead divided by the budgeted production. Okay. Here in our budgeted information, there is no place where they give us the total production overhead like 500,000, 600,000. We don't have. We don't know. Like we only know per unit what is the production overhead. So this figure is not there. Total production overhead. Budgeted production we have. That was 2,000. What you have to understand here is, in this question, the standard FOAR per unit is given directly. It's 20 per unit. Okay. That is why even though this total production overhead figure is not given to us directly, we don't have a problem, because the answer, which is the total production divided by 2,000, they're telling us the answer only is 20. Okay. Can you see it's a per unit figure? So you can directly write that 20 here. 20, 20. Let me show you something here. Okay. Wherever there is a OAR, see here, this is something to do with units. Something to do with units. It's multiplied by a OAR per unit. Look at the variable overheads. This was an hourly figure. So this has to be multiplied by another hourly based OAR. An OAR per hour, because you are multiplying it with hourly based figure. Here also is hourly based figure. This has to be a VOAR per hour. Understood? So what we are multiplying the OAR with, if it is an hourly based figure, this also has to be denominated by hours. In this case, this is a unit based figure. That's why the FOAR, we have to take it per unit. Okay. Right. So 2000 into 20, that will be 40,000. And 1750 into 20, that will be 35,000. All right. So this one is called expenditure. And this one is called volume. Let's get the differences. 37,410 minus 40,000 will be 2,590. 40,000 minus 35,000 is going to be 5,000. Figure out which one is adverse or favorable. Okay. If you look at the expenditure variance, no problem. This is the budget. This is the actual. So we are supposed to spend 40,000. We have spent 37 odd thousand. Good thing we have spent less. So this is straightforward. It's a favorable variance. Volume, deciding adverse and favorable is not very straightforward. FOAR rate, it was given in the question. Directly it's given that the fixed production overhead is 20 per unit. See? So there was no need to calculate. It was given here straight away. We just put it there. Okay. If it was not given, like if they had given us that the budgeted production overheads is, let's say, 45,000, then that you have to divide it by 2,000 and get the OAR. But here it was directly given. Okay. Now this volume variance, guys, getting the adverse or favorable is not, it's not straightforward like the others. You might have seen the problem. Usually, we have to have one box as budgeted, one box as actual. Here we have the budgeted, but the other box is what? It's saying absorbed. We are not sure what it is. Is it actual or is it budgeted? What is it? Okay. So you have to think in terms of absorption. So think about it. We are supposed to absorb according to my budget. Okay, according to my budget, we are supposed to absorb 40,000. We have absorbed less. I should have absorbed 40, but I absorbed less. I only absorbed 35,000. Meaning there is a situation called under-absorption. Under-absorption is bad for us, so it will be adverse. I don't want to go into details. I can if I want to, but I don't want to confuse you. Because my goal in this TRG is to make sure that you have enough to answer the question. Okay, so I don't want to start talking about under-absorption, over-absorption and stuff. Okay, because we have already spoken about it. It will connect to this chapter, but that will definitely confuse you. Okay, so I don't want to talk about it. No, adverse. That's what I'm telling you, Akil. If it is confusing you, then the best thing for you to do is to remember what I'm saying. Okay. I budgeted to absorb 40,000. Okay. I budgeted to absorb 40,000. I absorbed less. Absorbing less is under-absorption. Okay. Remember, under-absorption is always adverse. I can explain it to you, but don't ask me to explain again the reason behind it. So since he's asking, I will explain it. Okay. Why is under-absorption adverse? Okay. Because it's like this. If I was supposed to, in my costing, initial costing, if I was supposed to have a cost of 40,000, I was supposed to have a cost of 40,000, but I only have included a cost of 35,000, then what have I done? I have understated my cost. Okay, I have understated my cost. If I understate my cost, that means I have overstated my profit. Okay, follow me. I didn't want to explain this. One of you asked me, so that's why I'm explaining it. I know that people can't understand this. That's why I'm telling you, remember, under absorption means it is adverse. Okay, but I'm explaining the reason. If some of you can get it, then that's fine. But again, you don't need reasoning for variances. Okay, there is another area where you need reasoning. When we come to that, I will talk about it. In this position, you don't really need the reasoning. That's why I'm not talking about it. Okay, but anyway, since you asked, I'll repeat, okay? We were supposed to absorb 40,000 into the cost of this particular product, into the cost. But I have not absorbed 40,000. I have absorbed less. If you have absorbed less, that means the cost is understated. Meaning the cost is lower than what it should be. If a cost is lower than what it should be, then the profit in your accounts, it would be overstated. If I was supposed to have a cost, I didn't show the real value. I showed a value that was less. So obviously the profit will be higher than the real value, overstated. Now in absorption costing, when you overstate your profit, okay, the corrective action that you're taking will result in the profit actually reducing after correction for this under absorption situation. Now, if you overstate it, you can't just say, sorry, I overstated and forget about it. No, you have to correct it. So when you're doing this correction, what will happen is the profit figure, it will reduce, because if it reduces only, it means you have corrected for this under absorption. So when the profit reduces, profit reducing is always a bad thing for us. So that is why this is adverse. Did you get it? Because if you got it, then great. That's the reason for it. Okay. If you want, I'll go once more. But if you're not getting it, don't worry, because they can never ask you the reason behind an adverse or favorable variance for volume variance. Okay. So I'll go once more. I was supposed to recognize 40,000 as a cost. I was supposed to recognize 40,000 as a cost. I recognized only 35,000. So that means the cost figure, it is understated by 5,000. Cost is 5,000 less than what it should be. If a cost is less, then the profit that you calculated using that cost is more by 5,000. So when I make corrections for this overstatement of profit, I will actually reduce my profit by 5,000. Only then I have corrected the problem. So when I make this correction and the profit reduces by 5,000, profit reducing is always bad for me. That is why this becomes adverse. Okay, that's the reason why it becomes adverse. So this part, that's the logic. But if you want, if it's easier for you, then as a rule, remember that when there is a situation where we are having under absorption, under means, just think, under is bad, adverse. If it is over absorption, it will be favorable. Is that clear? Some lecturers don't even go to that extent. Some of them, they just say this. Look at the budgeted units. Look at the actual units. If the actual units is actually dropping, it's adverse. If the actual units is increasing, then it is favorable. Actually, that works 100% of the time. Okay, there is no logic behind that, but it works. Okay, so I didn't want to say that, because then it will be like I'm asking you to memorize something just like that. But I'm telling you, I have taught you 3/4 of it. To understand that it is under absorption, you have understood it. I know that. Only thing is, you might not be understanding why it is adverse. So just remember, if it is under absorption, it has to be adverse. If it is an over absorption, it will be favorable. Okay, so as a rule, remember, no problem, right? Nobody's going to ask you to explain this. Some areas, very few areas, about 5% of areas, you will see me saying, remember this. Okay. Some things I will, encourage you to learn the logic behind it. So this is one area where I will prefer you to just remember this. Okay. Because in your exam, guys, even if today you understand the logic, in your exam, you won't have the, mental capacity to think so much. It's under absorbed, cost is understated, overstated, profit, is it adverse? You won't have that capacity because you're already, tensed. So in that kind of a situation, just remembering this as a rule will help you more than the logic. Okay. Right. So take it down. So this is what I've said. Under absorbed is adverse, over absorbed is favorable. Remember it. In case you have to take it down, you can take it down. Okay. Okay. Note this down as well. Right. So now let's go back to that chart. We have done expenditure and volume. Volume can be split into capacity efficiency. I'll talk about that in a bit. Okay. But these are the main two which we have learned. Finally, let's do the sales variances. If you can do this, this is basically 90% of variances. Everything after the sales variance is just additional areas. Okay. Right. So look at the sales variance. Now the thing about the sales variance is there are two ways to compute it. And why are there two ways? Because we have two types of costing. We have absorption costing, we have marginal costing. So if we are using absorption costing as a policy, company decides whether it's absorption or marginal. Yeah. So if you are using absorption costing, then the sales variance will be calculated this way. If you are using marginal costing, there will be a small change, not much of a change, just a small change. Okay. Let's do this. So when it comes to the sales variance, again, three boxes, actual, actual at standard, standard. But the sales variance, this actual at standard box is it's always divided into two. If you remember direct materials, direct labor, we divided it only if there was closing stock or idle time. Otherwise, generally it was just one box, right? But when it comes to the sales variance, it is always divided into two. By default, it's divided into two. Right? So under the actual box, you have actual quantity sold into actual price you sold at. Here you have actual quantity into the standard price, actual quantity into standard profit, budgeted quantity into the standard profit. So let's add one by one. It's easy to get the figures from the data itself. Actual quantity sold. Let's see. Number of units that you have produced and sold is 1750. Actual price, how much did we sell it for? We don't know. But we know in total the revenue was 218,750. Okay. So let's put in what we know. 1,750. Actual price we don't know. But we know that when we sold this 1,750, we made revenue of 218,000. Change the color. 750. So per unit price we don't know. If you want, we can calculate 218,750 divided by 1,750. Actual price is actually 125 per unit. Let's go to actual quantity again, 1,750. Here also they're asking actual quantity, so I'll put that also. Standard price. So standard means we have to go to the budgeted part of the question. They're saying the standard selling price is 120 per unit. Straight away it's given to us. So that also we don't have to think too much. We can put 120. Then standard profit. Let's go back to the question. Standard gross profit, 38. Can put that as well. And here again they're asking for standard profit, so 38. Budgeted quantity to sell, okay? Remember budgeted sales. When you're talking about the sales variance, you don't take the production quantities. It's always the sales quantities. So budgeted quantity for sales is 2,000. Okay, 2,000 into 38. Right, so let's get the answers here. 1,750 into 120 will be 210,000. 1,750 into 38 will be 66,500. 2,000 into 38 will be 76,000. Okay. The first one is called the sales price variance and the second one is called the volume profit margin variance. Okay. Let's get differences. 218,750 minus 210,000 is 8,750. Here 66,500 minus 76,000, 9,500. Okay, now watch carefully how I'm deciding whether this is adverse or favorable because this is a sales variance. It's not a cost variance. Okay. So for the price variance, this is the budget, this is the actual. I'll give it to you in a bit, okay? Not right now because I'm doing the sales. I'll come back to it in a bit, okay? Right. So this is the budget because it has a little bit of standard. This is the actuals. Now watch carefully how I'm deciding adverse or favorable, okay? Because sales variance means we have budgeted to get 210,000. Okay, we have budgeted to get 210,000. We have got how much? 218,750. So we have got more. Getting more is a good thing. And so this becomes a favorable variance. Okay, we are doing the opposite because in cost variances, how will we think? We were supposed to spend 210. We spent 218. We spent more. So that's bad. It's adverse. But careful. That is only in the cost variances. For sales, you have to think in terms of income. So if you get more income, that is always a good thing. So that is favorable. Okay, so you have to be careful there. Then between these two, this is the budget, this is the actual. We were supposed to get 76,000, but we got less. We got 66,500. Getting less is a bad thing. So this will be adverse. That's how you decide whether it is adverse or favorable. Okay. You can take this down. Somebody had asked me to do the fixed overheads. Thing is, I'm running short of time. If I have time at the end, I'll go through it. If not, these TRGs recordings are released. So you can have a look at it. Okay, because if I go back there, it'll just mess up my flow. Okay, if there is time at the end, I will go through it definitely. Right. So take this down. And then now we have to do something called adverse favorable part again. Yeah. So it's simple. One second. I forgot the name. Adil. It's like this. We have to first decide which box is budget and which is actual. Okay. And remember in the sales variance, actual and standard by default it's divided into two. So we don't, get the difference between 210 and 66. They are two different things. Okay. So look at the budget. We are supposed to get an income of 210,000 from this sales. But we have got an income of 218,750. So we have got an income of 8,750 more. That's good. So that is why it's favorable. Why did that increase? Look at it. We told the sales manager to sell it at 120. He has somehow managed to sell it at 125. That's good. That is why. So him being able to sell it at 125 is always a favorable thing for us. Okay. Look at this. Here, this is the budgeted box. The last one, third one. The actual at standard becomes the actual box. So we budgeted to get 76,000 from the sale, but we only got 66,500. We have got less. If you get less from the sale, then that is a bad thing. It becomes an adverse variance. Okay. No problem, Adil. Okay. Now, another area where they tend to question, how they question variance analysis is using something called the reconciliation statement. Okay. And for absorption costing, it will look like this. Okay. For absorption costing, the reconciliation statement, it will look like this. So how does it look like? It starts with the budgeted profit. Reconciliation means what? We are trying to see why there is a difference between the budget and the actual. So it starts with the budgeted profit. What should the profit, what should it have been? And it ends with the actual profit. Okay. So this is the budgeted profit. These are all the things that went wrong or went right. And finally, the profit that we get is this. Okay. So let me go through this one by one. Budgeted profit. So if we go to the question, budgeted information, we are supposed to get a profit of 38 per unit. And profit means what? Profit per unit into the number of units that you sell. So according to the budgeted sales, you're supposed to sell 2000 units. So 2000 into 38, that is the budgeted profit, which is what? 76,000. Then what do? We get the different variances and we put them one under the other. We start off with the sales variances. So we put the sales volume profit margin, which is this one. Volume profit margin, sales variance, 9,500. It's an adverse variance. Adverseness, that's why we make it a negative figure. It's a bad thing for us. Profit is a good thing. So we deduct it. 76,000 minus 9,500, it gives you 66,500. So that's a total. We call that standard profit on actual sales. So there is, instead of, getting it as a total, there is a way to calculate it also. That is, get the standard profit, which is 38, and multiply it with the actual sales. So the actual sales was not 2,000, it was 1,750. So 38 into 1,750, 66,500. Then we put the second sales variance, which is the sales price variance, which was 8,750. And we add it to the standard profit on actual sales. You get a total here, 75,250. Okay. Then one under the other, you start putting all the variances that you calculated. So direct material, direct labor, variable overheads, fixed overheads, everything that you calculated. If it was adverse, you make it a negative variance, negative number. If it was favorable, it will be a positive number. Okay. So let me show you. You can also look back at your notes and see. Direct material, price and usage, both were adverse. One was 1954, the other one was 580. The total was 2,534 adverse. Okay, so we are just putting those figures in. Okay. Then direct labor, if you look, this is without closing stock, okay, without closing stock and without idle time. So here, rate was 4,361, 168, both are favorable. Total is also favorable. Okay. Here, expenditure was adverse, efficiency was favorable, total was adverse. Fixed overheads also, this is with idle time, sorry. Fixed overheads also, expenditure was favorable, volume was adverse. You can get a total also, which was adverse. I'll write it. It will be adverse, how much? 2,410. So what I'm doing is basically, I'm writing down all my variances that I calculated till this point. Okay, I start off with the sales variances. Then I put all the other variances. So see, price, the total was an adverse variance, so it is negative. Direct labor, look back at what you copied down. The total was a positive favorable variance, so that's why I have added. Variable overheads, the total was again adverse, so that's why I deducted. Fixed overheads, just now I calculated it. It was 2,410 adverse, so that is why I have deducted it. So then what have I done? 75,250 minus 2,534 plus 4,529 minus 8,666 minus 2,410. It will give me the actual profit that I calculated or that they gave me, 66,169. So what have I done basically? I have started at the budgeted profit. And I have given all the reasons why things went not according to our plan. Because actuals were different only, all these variances happened. And then finally, I arrive at the actual profit and say, see, actual profit is 66,169. That's exactly what I have in the question as well. So I have given you the reason why the budgeted and the actual is not the same, and I have actually given you all the breakdown as well. So now if a manager comes and sees this, he will see, okay, direct material was adverse. So he will try to call the person in charge of materials and see why that was adverse. Direct labor has been favorable. Both rate is also favorable, efficiency also favorable. So then he might, call that person and give him a bonus. Variable overheads, expenditure was adverse, efficiency was favorable. So maybe the workers are working fast, but something to do with the amount that we are paying for the variable overheads, we have to, correct whatever is going wrong. Fixed overheads also, you can see volume is adverse, this is favorable. So you know exactly whom to question, and keep the right people accountable for the adverse variances. Okay. So what can happen at your exam is very simply, they can give you a statement like this, but maybe not give one answer. Like the sales price, they will say, find the sales price, that will be X. Then you should be able to work backwards and figure out what that figure will be. So don't worry, next week we will go through questions how it works with the reconciliation statement. Okay, so for now, I just want to cover the theory. This is the reconciliation statement for absorption costing. Okay, so you can take this down, make it a point and take it down right now, because if not, you won't understand what's happening. When you write this only, you will understand what has happened. Okay. So by the way, you have to know this format, right? Like how you know how an income statement works, how a balance sheet will look like. You have to know how this reconciliation statement will look like as well. It's a standard format, okay? It's always the sales variances at the top and then all the cost variances underneath. And this AF, obviously, you would have figured it out. It's adverse and favorable, okay? Okay, so I hope you've taken this down. Absorption costing, this is the reconciliation statement. Okay, there can be a small change. You might have guessed at this point. It is if there is closing stock or idle time involved, how will the statement look like? Nothing much, just a small change. Okay, so let me show you that as well. So the same thing, we start with the budgeted profit. We deduct the volume profit margin variance because it's adverse. We take a total. Then we add the sales price because it was favorable. We get a total again. Then we put in the direct material variances, direct labor. This time there will be 3 because idle time is also a variance now. So it won't be just rate and efficiency. You will have idle time as well. We have that also in our answer. No problem. All of this is the same. But finally, when we get the actual profit, it won't match with the question. Because question says 66,169 no, because the question didn't take into account the closing stock. Okay. So if the question had closing stock, then the actual profit will be 66,169 plus the closing stock valuation. Okay. So don't get me wrong, right? In my question, my original question doesn't have closing stock. That is why we didn't get a profit as 67,249. But if in a question originally there was closing stock and idle time, then in the question itself, the answer for actual profit will be 67,249. So here it is not matching with the question because the extra 1,080, which is the valuation of the closing stock. Okay. So again, it's the same thing, nothing much. It's just that idle time will be added and in the actual profit, you will have the value of the closing stock included in it. Okay. So you can quickly, in the statement that you have copied down, you can just add these two and say what will happen if you have idle time and closing stock. If you are not comfortable doing that, copy this again, even no problem. But you have to know the difference. Okay. Right. So I hope that's enough time to add that in. Okay, we have time, so that's good. What we have done till this point, guys, is absorption costing. You and I both know that. But obviously, management accounting means there are 2 types of costings that we can have. You can either go for absorption costing or you can go for marginal costing. So now what if we had gone for marginal costing? That's the question. Okay. Only 2 changes, of which one is a good change. The second one is actually a change. Okay. What will happen if a company is going with marginal costing? What will their variance analysis change like? Okay. I'll go back here. Until fixed overheads expenditure variance. Okay. So that is price, closing stock usage, rate, idle time efficiency, expenditure efficiency, and again the fixed overhead expenditure. All of them are identical. No changes whatsoever. Absorption costing, marginal costing, both will be the same. Then you will have the obvious next question. Okay, what happens to the volume variance then? Volume variance, it gets cancelled off. In marginal costing, you can't calculate volume variance. I'll tell you the reason for that. If you look at the volume variance, expenditure was actual and budgeted data. Volume was budgeted and absorbed data. Where do we have absorption in marginal costing? We don't have. Absorption is entirely a concept that is to do with absorption costing. So in marginal costing, because we don't absorb the fixed overhead into the cost unit, we just forget about the volume variance. There's no way to calculate it. That's easy. Okay. Sales variances, there will be a very, very small change. Okay. What is that change? I will show you here. I'll highlight the change. Just this. That's not visible. Standard contribution. Because if you remember, guys, when it comes to marginal costing, very rarely do we take a decision based on profit. Yeah. A better, a better figure that we can calculate is something called contribution. So what is this contribution? It is the selling price minus all variable costs. So all variable costs, variable production cost, as well as even if there are variable selling cost, anything variable, we will deduct it from the selling price. Okay. So if you're using marginal costing, very rarely will you take decision based on the profit. So you can see the sales variance when it comes to absorption costing, we say it's actual quantity into standard profit, budgeted quantity into standard profit. Marginal costing, we prefer to take decisions based on contribution. So that is the only thing that changes. Two things. What was it? No volume variance. So that's good news. We don't have to worry about it. No volume means capacity efficiency. I told you volume also can be broken into two. That is also cancelled. If the main thing is not there, you can't have the sub one. And when it comes to sales variance, you will have to calculate based on the contribution. Okay, so this same question, let's do it let's calculate the sales variance if we are using marginal costing. Okay. Right. So let's do it once more. Let's get the question. Actual quantity sold into actual price. It's the same. Actual price we don't have. Quantity is 1,750. Total is 218,750. Okay, so this is 218,750. 1,750 into, if you remember, it was 125. Okay. Then again, actual quantity 1,750 into standard price, which was 120. Same thing. Okay, there is nothing different. These are the same. The price variance is the same. Only this volume variance, it will change. That will be 210,000. I'll get the price variance. Then we have the quantity. Actual quantity again 1,750. Budgeted quantity, if you remember, it was 2,000. Okay, so let me put that as well. So it will be easier for me. Now I just have one more figure. If I can get that standard contribution, I'm done with variances. Okay. So let's go to the standards. I told you that contribution is the selling price minus all variable cost. One second. I'll erase this. Contribution is the selling price minus all variable costs. So let's take the selling price. I'll write this here. Contribution, selling price minus variable cost. Selling price is 120. Okay, selling price is 120. Then let's take all the variable cost. Direct material is variable, so minus 22. Direct labor is also variable, minus 30. Variable overhead is obviously variable, minus 10. Fixed production is not variable cost. This is a total standard production cost. That is a total. Okay, that's a total. Profit, we don't have to take it. Selling price. So we have taken all the variable costs. 120 minus 22 minus 30 minus 10. So you will get contribution as 58 per unit. Standard contribution. We are using budgeted data. So let's put the 58. 58, 58. 1,750 into 58 will be 101,500. 2,000 into 58 will be 116,000. Now this is price variance, no problem. This is called the volume. In absorption costing, it was called volume profit margin. Here, we don't use the term profit. We say volume contribution margin variance. That's the only difference. Volume contribution margin variance. Okay. Right. So here the price variance, we had calculated it before. The difference between 218,750 minus 210,000 is 8,750. My budget is this. My actuals are this. I was supposed to get 210,000. My budget. I have got more. I've got 8,750 more. Getting more is a good thing. This is favorable. Like in absorption costing. Here, let's decide what is the budget. This is the budget because it has only standard information. This has a little bit of actual. So this is actual. According to my budget, I was supposed, sorry, let's first get the difference. 101,500 minus 116,000 is 14,500. Okay. I am supposed to get, according to my budget, 116,000. Sales, I'm supposed to get from my sales 116,000. But I have got less. I have got only 101,500. Getting less is a bad thing. So this is an adverse variance. Okay. So everything is the same. Only thing is, instead of using standard profit, we use standard contribution. This is how the sales variance will change. You can take this down. After this, we have to do the reconciliation statement if we are using marginal costing. So not much of a difference. It will be just a few, figures will change here and there. Take this down and we'll do the reconciliation. Okay, so I hope you've taken this down. Let's see how a reconciliation statement will look like in marginal costing. Okay, so I'll just highlight the differences. So in absorption costing, you can look at your whatever you have copied down. We would usually start with budgeted profit. Here, we don't use profit, so we start with budgeted contribution. So contribution, we calculated it as 58. The budgeted number of units we were supposed to sell was 2,000. So 58 into 2,000, which is 116,000. Then as always, we will put in the sales variances first. So the first variance we will put is the sales volume contribution margin, which was a adverse 14,500. We get a total there, 101,500. We call it standard contribution on actual sales. There is another way to calculate this as well. Standard contribution we know is 58. Actual sales was not 2,000, it was 1,750. 58 into 1,750 also should give you 101,500. Then we put the sales price variance as always favorable 8,750. We take a total. Then we put the direct material price, usage, direct labor rate efficiency, variable overheads, expenditure efficiency. Okay. And then usually under absorption costing, we would have put the fixed overhead variances as well. But under marginal costing, we will take a total here and we will call it actual contribution. Because we can get that figure, right? Because before fixed overheads are deducted, selling price, everything to do with the sales, minus all the variable cost, it will give you contribution. Okay, so we can't just omit that figure. We have to take a total and find out what is actual contribution. Then you can take the budgeted fixed overheads. Okay, so what is the budgeted fixed overheads? That is, if you look at our budget, there is a question. Yeah. The overhead, fixed production overhead was supposed to be 20 per unit. Okay, it was supposed to be 20 per unit. So 20 into the number of units that we budgeted to produce, which is 2000. Okay, so 2000 into 20, that will give you 40,000. Okay, 2000 into 20, that will give you 40,000. So this is a new thing. We put the budgeted fixed overhead figure. Then we will anyway have fixed overhead expenditure. No, volume is only not going to be there. Expenditure you will definitely have. So that it's a favorable variance. We will put it over here. Okay, now you might have a question. Why are we deducting a favorable variance? It should be there because usually if the variance is adverse only, we will deduct. But this is the only situation where we are deducting a favorable variance. The reason for that is 40,000 is a cost. Fixed overhead cost, budgeted cost. The actual is 37,410. That also we have in the question. So basically this favorable variance, it has reduced your cost. That's why it's favorable. That is why we deduct it from the 40,000. Because it's a good thing. It reduced your cost. So if you put this as a positive figure, then we will say that fixed overhead is 42,590, which is wrong. Fixed overhead was actually 37,410. But again, that is an expense. So that you will deduct from the actual contribution. So 103,579 minus 37,410, you will arrive at the actual profit. Okay. So what I have highlighted is the thing that will change in a marginal costing reconciliation statement. You don't have to worry about closing stock idle time. If it is marginal costing, they won't complicate it more. Okay, so just know this. This is more than enough. Right, so you can take this down. One more thing I have to say is, this actual contribution we have calculated is there, right? It's actually very important figure. If you're a management accountant doing marginal costing, you will take a lot of decisions based on this actual contribution figure. Okay. So, there can be a situation in the next slide you will see where you won't have this actual contribution. I'll talk about it. But just remember that this actual contribution, it can be used to take a lot of decisions. Okay. Right. So you can take this down as well. I know I have to rush through the last bit, but I believe that at this point you should be reasonably comfortable with variance analysis. Okay. Because usually this takes about, to be honest with you, it takes about 5 to 6 hours, to teach variance analysis slowly. Because, usually all of these numbers, I type it in front of the student. But because this is just 3 hours, I don't want to, do that because I won't have time. That's why I've just left it as it is. So I know it might be a little bit fast, but hopefully you should be okay. Because the important part, I have given you the time. Okay, the part where you should know how to calculate these things, that is very important. Okay, so I have given the time for that. The reconciliation statement, because of time constraints, I have to rush through it a bit. Okay, so if you feel that, you missed a bit here or there, don't worry. The recordings will always be shared with you. Okay, so you can go through it if needed. Okay, so while you're taking this down, I'll just explain the third. Now so far we have done three reconciliation statements, right? For absorption costing, we did two. One without closing stock and idle time, the other one with it. Marginal costing, so far we have done one. So there is just one more reconciliation statement for marginal costing. And it's not to do with closing stock or idle time. So I'll explain that. Now, what you have to understand is a normal manager, not a financial manager, maybe somebody into marketing or production or HR, they usually don't understand this word contribution. It's not a word that is easily understood when you compare it to profit. Now, profit means anybody can understand what it means, right? Okay. But contribution, usually a non-financial manager, they will find it difficult to understand what this 116,000 actually is, because they don't know the concept of contribution. Okay. So if this report is going to go to a non-financial manager, then sometimes, although we are using marginal costing, we will prefer to start and end with a profit-based figure. So the ending is actual profit, no problem. We will prefer to start with budgeted profit. Although it is not part of marginal costing, right? In marginal costing, very strictly we use budgeted contribution. But sometimes, just to help a non-financial manager, maybe the person who is reading this report is a non-financial manager. So in that case, we will start and end with a profit-based figure. So now we have to learn what is the third statement for marginal costing and how it will look like if we are going to start and end with profit. Okay. It becomes a little less complicated than the previous one. Okay. So this slide, I'll just go through it. It says here, as seen, we have computed variances under both absorption and marginal costing. Usually we prefer absorption costing. And then what I said, okay, marginal costing reconciliation reconciles budgeted contribution with actual profit. But sometimes it may be required to reconcile budgeted profit with actual profit. Okay. Right. So how do we start budgeted profit? So according to my budget in the question, if you remember standard gross profit, it was 38. We multiplied with the budgeted number of units that we were supposed to sell, which was 2,000. We get 76,000. Then you put the sales volume. It's a contribution margin, right? Because marginal costing now, so we can't put the profit margin. We don't have that figure. So sales volume, contribution margin, sales price, that's also given. This 61,500, it doesn't have a name. Usually standard, over here it is the standard contribution on actual sales. No, here we can't really calculate that figure because this is a profit figure. From that we are deducting a contribution based figure. This will just be a blank total. Okay. Then we put the direct material, direct labor, variable overheads, fixed overhead, expenditure variance is also put. And we just take 70,250, deduct these 3, 4, and then you will get the actual profit. So it's a lot easier if they ask you to reconcile budgeted profit with actual profit using marginal costing principles. But there is a small problem, and that is by doing the statement like this, you miss out on a very important figure. What is that figure? This actual contribution. If you do the reconciliation statement like this, reconciling budgeted profit and actual profit, and it's a marginal costing based company, then unfortunately there is no way for you to calculate the actual contribution. That's a disadvantage. You have to live with it if you want to present the statement like this. But like I said, actual contribution is a very important figure for decision making. So if you are going to opt to do it using this format, then you have to be prepared to make that sacrifice, not get that figure. Okay. So I can take this down as well. There are 4 reconciliation statements that you have to know about. Now that is basically a good wrap up of variance analysis. But I know I have 10 more minutes. I just have one more area to cover. Okay, you must be knowing what it is. Please bear with me. Just 10 more minutes and then variance analysis will be done. So I'll give you a minute to take this down. And then we'll just do the last area. Okay. So I'll go back to the first thing that we started off with. So we have done everything here. The only thing that we haven't done is calculating this capacity and efficiency variance. Okay, so let's quickly do that. That won't take time. Okay, so it's basically trying to get the volume variance, fixed overhead volume. You should know how to calculate it. It's a way to split that variance as well. So sometimes they can ask for capacity efficiency variances. Good thing here again is if you're doing marginal costing, then there's no way to calculate capacity efficiency because volume variance itself is not there. But if you're using absorption costing, then the volume variance will be there. So you might have to calculate the capacity and the efficiency as well. Okay? Right. Okay, so you can just go through this. Okay, I'll just read it for completion. There are two reasons as to why the actual volume of output is different from the budget. So volume means the number of units that we produce is different. That's why there is a volume variance. So what you have to understand is there can be two reasons for that. One is maybe the workers worked for longer or they worked for shorter. So that is the capacity variance. The number of hours worked is different. Or the workers, they worked faster or slower than the budget. That is the efficiency variance. So the volume variance, you can divide and see, did it happen because the workers worked for longer or shorter, or did it happen because they worked faster or slower? So if it was because they worked longer or shorter, then that is the capacity variance. If it is because they worked faster or slower, then it is the efficiency variance. Okay. So this is the fixed overhead capacity and efficiency. We already spoke about it. It's the same thing. How does the capacity and efficiency, this is the fixed overhead expenditure and volume. Okay, that we already spoke about. We even calculated it once. Okay, so this is just a repetition of that slide. Now, how do we split this volume into capacity and efficiency? Sorry, it's been a long day for me also. Capacity and efficiency. Okay. So how we do that is we have again three boxes: budgeted, actual at standard, and absorbed. Okay. So this budgeted and absorbed is the same. It's just that in the middle we get another box saying actual at standard to split it. So here budgeted hours into standard FOAR per hour. Here it will be standard hours for actual production into standard FOAR per hour. Then you will have the actual hours into the standard FOAR per hour. So these are the equations that you need to know when it comes to capacity and efficiency. Okay. But I will highlight something here. When it is the volume variance, this is the standard FOAR per unit, and this is units, budgeted units, actual units. But if you are splitting the volume, then you are talking about budgeted hours, standard FOAR per hour. Hours, standard FOAR per hour. And here also it's the per hour figure. Okay, so it's not the unit-based figure. We are more concerned about the hour-based figure. Okay, so careful there. Right. Okay, so let's directly go into the question. This is a separate question. You can take it down later. This is how you would calculate capacity and efficiency. Okay, so it says here, L operates a standard absorption costing system. The fixed overhead absorption rate is based on machine hours. Data for October are as follows. Number of units produced, budget actual. Number of machine hours worked is given. Fixed overheads, budget and actuals are given. Calculate fixed overhead expenditure, volume, capacity, efficiency. So everything to do with the fixed overheads. Okay, so somebody asked for a recap. If you're still in the call, you should get it with this question. Okay. Right. So this is first, let's start with the expenditure and the volume. Actual overheads that you incurred, there is no formula. It has to be directly given in the question. It's given here. Actual fixed overhead is 96,400. Oh, sorry. I'm copying the wrong slide. Here, okay. 96,400. Budgeted units into standard FOAR per unit. So let's go here. Budgeted units is how much? 5,000. So let's write it down. Standard FOAR we don't have. Actual units was 4,800. So that also let's write it down. How do we get this standard FOAR per unit, right? There is an equation, I mentioned it earlier. Standard FOAR per unit is the budgeted fixed overheads over the budgeted production. Okay, so you can look back, this equation is given. So budgeted fixed overheads was 100,000. Budgeted production was 5,000. So the fixed overhead absorption rate per unit is 20. You can directly put it here, 20 and 20. Take totals, 5,000 into 20 will be 100,000. 4,800 into 20 will be 96,000. Okay. Differences 100,000 minus 96,400, 3,600. And here 96,000 minus 100,000, the difference is 4,000. I told you here volume variance only, you have to be careful with the adverse favorable. Expenditure is as normal. We were supposed to spend 100,000. We have spent less. That's a good thing. So this is going to be a favorable variance. Here, we were supposed to absorb 100,000 because that is the budgeted. We have absorbed less. So that is under absorption. Always remember, under absorption means what? You should remember at this point, under absorption means it is an adverse variance. Okay, under absorption means it is adverse. So that's the straightforward expenditure and volume. Now let's do capacity and efficiency. So it's a breakdown of the volume variance. So basically this is the volume variance which was 4,000 adverse being broken down into capacity and efficiency. So here the equations change a bit. Budgeted hours into standard FOAR per hour, actual hours into standard FOAR per hour, standard hours for actual production into standard FOAR per hour. So let's put the hourly figure since it's directly given. Budgeted hours and actual hours. Let's see. Budgeted hours, they're talking about machine hours. So remember this. If you need to calculate capacity and efficiency variances, you have to have machine hours or labor hour information. If you don't have that information, you can't calculate the capacity and efficiency variances. So that will be 10,000 budgeted, 10,300 actual. So budgeted is 10,000, actual is 10,300. Standard FOAR per hour, I'll calculate. Standard hours for actual production. Actual production we know was, sorry, this is another question. No. It was 4,800. Okay, actual production was 4,800. And what was the standard hours that we allowed? Let's look. Okay. The standard hours that we are allowing is, look here, for 5,000 units, we are allowing 10,000 hours. Okay, so 5,000 units, we are allowing 10,000 hours. That means for 1 unit, Okay, standard hours per unit, that will be 10,000 hours divided by 5,000 units, which is 2. Okay, so for 1 unit, we are allowing them to use 2 hours. Okay, how did I know that? For the entire 5,000, I gave them 10,000 hours. So if I want to know for 1 unit how long I can give them, that is 10,000 divided by 5,000, which is 2. Okay, so this will be standard hours will be 2. Now finally, we need to get the standard FOAR per hour. So how do we get that? I'll write the equation here. Standard FOAR per hour equals the budgeted fixed overheads divided by the budgeted hours, because this is an hour figure. Budgeted fixed overheads 100,000 divided by the budgeted hours, which is 10,000. Okay, so 100,000 divided by 10,000, which is 10 per hour. 10, 10, 10. So you can see in the previous question, they didn't give me this machine hour story. If you don't have that machine hour data, then there is no way for you to calculate capacity and efficiency. Okay. If you have it only, you can do the calculations. So let me quickly do this. 100,000. This will be 103,000. This will be 96,000. Get the differences. 103,000 minus 100,000 is 3,000. 96,000 minus 103,000 is 7,000. Okay, now here also, volume also getting adverse favorable is a little tricky. Here also it's tricky. So how you have to do this is, capacity means whether they worked more hours or less hours. Now in terms of capacity, if they work for longer, it's good because we told them to work only for 10,000. They have worked for more means that is good for us. So look here. We told them work for 10,000 hours. They have worked for 10,300 happily. That's always a good thing. Meaning, in a case of emergency, our workers are willing to work overtime. So that means the capacity variance is favorable because they have worked longer than what we asked them to. If you look at efficiency variance, let me take a total here. 4,800 into 2. How much will that be? 9,600. Now, I have told my workers finish the work in 9,600 hours. That is only the standard now. So I have told them finish the job in 9,600 hours. What have they gone and done? They have taken longer time. They have taken 10,300 hours to do the job. Meaning they were slower. So in terms of efficiency, being slower is not good for me. In terms of capacity, taking longer is good because that means they're willing to work for longer. But in terms of efficiency, taking longer means they are being slower than what I asked them to. That's bad. So this will be adverse. So you can see when you put it together, 7,000 adverse minus 3,000 favorable, you will get the volume variance of 4,000. So it's just a split off of the 4,000. Okay. That's it. That is all for variance analysis. Okay. So if you can do up to the reconciliation statements, the 4 statements, that is 95% of the time what you will get. The extra 5%, rarely they can ask you to get the capacity and efficiency variance as well. But again, if they ask you for it, they have to give you all the hourly based data. If they don't give it, you can't do it. Okay, so make it a point to know all the equations. Right, so these are just theory based stuff, the reasons for variances and stuff. We can go through them while we do the MCQs. Okay, so we will definitely come across them. In terms of calculations, everything is done. Finally, to help you guys out, I have the variance summary, which is a comprehensive document which summarizes all the equations that you need. Okay, so right now I will send it on the Telegram group. Take a printout of it, keep it with you, learn from it, and just, there might be a little alignment issue. Okay, there might be a little alignment issue. Oh, yeah. I just saw that. It's not FM, right? It's MA. Just check with the slides also. I have not shared the slides. No, I will share the slides also. Um, in case there are alignment issues, just correct it. Okay. So this document, I'll open it also. Let me share the slides as well. Chapter 15. Okay, so you can double check with the slides in case you need it. So what does this document talk about? I'll show it. Basically, it's put in a way where it will be easier for you to memorize it. Okay, so I have direct materials on one page, direct labor on the other. Then I have variable overheads on another page. Then I have everything to do with fixed overheads here, including capacity efficiency, how to get standard FOIR per hour, how to get the standard FOIR per unit, everything is there. Okay. Here I have the sales variances, absorption costing, marginal costing, both, and the 4 reconciliation statements that you have to know. All 4, I have taken a screenshot. It's the same question and put it here. So definitely should help you out when you are trying to learn. Okay. Right. I have taken 5 more minutes. It's fine. That's it for variances. Learn it. Clear it in your head. Don't ever think that variances is confusing and stuff. Okay, we have gone from 0 to 100. So you shouldn't have a problem with variances after this point. Okay. Next week onwards, we will continue with that question bank that I sent. The BPP question bank, we will continue with that. And as we go through the questions, I will talk about the different areas. Okay. Right. Thank you for your time and your patience. I'll see you next Thursday again, 6 to 9. Okay.